All right. So in this video series, I'm going to try to explain the basics of investing in a way that is really hopefully clear and simple and assumes no prior knowledge and can get you up to speed with this whole concept, which is simultaneously can be very daunting and very empowering at the same time. So the purpose of this video is to basically educate you on the fundamentals of investing. There might be a lot of things that could still be covered, but you should have a far better understanding of this whole ecosystem by the time we're done. And so I assume no prior knowledge of anything to do with money, like absolute beginner is totally fine here. And just a bit about me is I have both a MBA and I've been fascinated by finances for years, as well as a master's in sociology with an emphasis on psychology. And the psychology of business is actually fascinating to me. The psychology of money, what it means to people. I'll talk about it more, but it's actually quite a loaded topic for a lot of people. So the intersection of pure finances and economics, plus actually how humans interact with that is fascinating to me. And I've had to teach myself this. I was not taught any of this growing up. I was raised quite, I would say, financially illiterate for the most part, other than a bit of emphasis around a bit about saving, but saving cash, which is not enough. We'll talk about that. And a bit around investing, like no attitudes towards investing, which were wrong, and a bit about being frugal. So frugality was emphasized, but there was no real talk about how to grow the money that you do have. And I'm proud to say that so far, I've been able to advise quite a few people on this. I've advised friends and relatives who have gone on and invested on their own. And I've supported people with higher net worth, people with over $1 million of their respected currency in their respective countries to manage their finances as well. It's been a real privilege to help people in a variety of life circumstances make more sense of their money and figure out their goals and what they want to do next. So let's start in the beginning. I want to actually talk about the emotions around this. So money is a very loaded thing. Money is one of the most emotionally fraught things for people. And because it represents a lot of potential. There's a lot of things you can do with money and things like freedom or obligation, huge themes for people. It's the way we really see our parents' experience around it, whether that's anxiety, whether that's irresponsibility, a lot of that around that. And it's really a metaphor, this concept of potential. It's very underlying. So I want to validate if there is fear, if there's reservations for you going into all of this, it's very valid, it's very normal, and take it really slow. And just recognize that you may be having emotional resistance here. Let the information wash over you. You don't have to be doing anything with it. Just let your subconscious make sense of this first. And even if you take tiny steps right now or feel like you're not ready, just hold yourself against that point where it feels like too much and recognize that it really is a big deal. And there's a part of us that can be really hard on ourselves, for example, about how we haven't invested so far or things like that, missed opportunities. It's very, very normal. And just let that be as you are. And I commend you for still taking this journey of information, because information is power. And once you demystify a lot of this, you'll see that a lot of it is a lot less complicated than it might seem. Let's talk a bit about a rather esoteric topic called inflation, but it really kind of is necessary to understand the importance of investing. So inflation, and the very basics of it, is just the concept that money over time becomes worth less. I grew up with my grandfather telling stories of buying a hot dog for 10 cents, right? And nowadays, the single penny is basically out of circulation. In Canada, where I am right now, a lot of the lower coins are being put out of circulation. And that's because what happens is over time, everybody starts trying to raise prices a little bit, as much as they can. So prices are slowly creeping up across the board everywhere, which means that money is worth less. The same amount of what a dollar got you 20 years ago, a dollar won't get you now. And that's just normal, this upward creep of things. But what that means is if you have cash sitting in your bank account, it's actually dropping in value every year because it will buy you less and less. So the rate inflation changes by country and by year. You could think of it broadly as around 2%. So everything goes up in cost about 2% per year. And what that means is that every year that your money is just sitting in your bank account, even if you have saved it, it's becoming 2% less each year. And so at the very least, the goal is to see if you can at least have it hold even. Can you make it somehow keep earning you 2% so that your money's not going down in value? But then if you're already doing that, can you actually have an increase in value? There's the concept of lost potential. Your money has the potential to make you more money just without you doing pretty much anything else. And we'll talk about risk soon, but assume that your money could make you more money with very little risk over time. It's a real shame to not do that. So we'll talk more about that. But inflation is the underlying kind of almost imperative to not keep all your money in cash in your account because it's actually losing you money every year. So let's talk about the stock market, which is going to be the main broad way in which I'm going to be talking about investing your funds. And to do that, let's take a step back for a second. Think about average Joe Schmo wants to open up a mom and pop shop, something really basic on your street local. He needs money to get started. There's usually two broad ways to get money for a venture, for a business that you want to start. You got to pay the down payment, 3 months rent. You got to buy inventory. You got to get some money out of hand and you don't have it. You have the experience. You've worked in retail for 20 years. You want to open a shop, but you don't have the actual cash. There's two broad ways to do that. You could go get a loan or you could find partners. You go to friends and family, say, hey, I'll borrow $20,000 from you and I will pay you 8% interest annually on this loan. And the beauty of that is they're not going to tell you what to do. If they trust you with the loan, you get to do whatever you want from there on, but you have to pay out. No matter how well your business does, if your business shuts down for whatever reason, COVID hits, you got to shut down, you're still going to owe them $20,000 with 8% interest. It's just the way it works. The other option is you go into partnership with them. You say to them, hey, put money in and I will give you, let's say, a 50% stake in this company. And if we make lots of money, I will disperse that money to you. And if we don't make money, we both lose, right? But because of that, they could also boss you around. They could say, hey, I'm a partner in this company. I don't like what you're doing, right? So there is that more involvement, but less theoretical risk for you. Those are the two broad ways that people in the world go into partnerships. On a macro level, the world economic system is built on those two ideas. There is a concept called bonds, which basically means that somebody issues a debt, meaning they take a loan from you and they owe you money back. And then there's a concept of stocks, which is basically you earning a share in the company. We're not going to talk as much about bonds because bonds generally yield a lower amount. But bonds are one of the ways in which we oftentimes can receive a lower but more stable payment. And bonds can come from all sorts of places. They can come from companies, but they often actually come from governments and municipalities, right? So actually, if the United States wants to raise some money right now and go to war or to build some new highways, they can actually issue debt and you can pay them money. They give you a note that says, we owe you money, and they will start paying you 2%, 3% a year. And that's what bonds basically are. Now let's move over to stocks. So stock market has existed for over 100 years now. And the concept basically is these big companies still want to make money and they want to get a lot of money in quickly. And what they do is they say, we will sell you a small percentage of our company in exchange for your money. So you give them money. They give you a little note or a virtual note that says you owe a piece of the company. And they are, at that point on, partners with you. You actually get to vote in how they run their business. It's just there's a lot of other people also voting. And you actually are supposed to get a small percentage of the business growth. A lot of times they defer that. That's a bigger topic. And most importantly, if the value of the entire company goes up, if everybody in the world agrees, oh, this company is worth twice as much as it was, and you turn around and sell it, you will get the increased growth of that was because you have a partnership. You actually own a share in the company. And so these companies are so big and there's so much buying and selling that happens that we're actually able to do this in an automated and broad way in these huge stock exchanges, right? So you could instantly, from your house, wherever you are, put in an order to buy or to sell a stock, and it will almost instantly be fulfilled. That is one of the huge advantages of the stock market is what we call liquidity. Compare that to buying a house where it could take months to find the right buyer and agree on the price and then sell it and all the transactions involved. The stock market and the bond market, for the most part, are quite liquid, especially with larger companies that are popular. And there's a very clear price at any given second, and you can quickly buy and sell. So that is just a broad overview of what goes on there. Now, we've already spoken about this, but basically the two main ways that you make money by holding a stock is if the money grows, so the growth over time of the business, and then also dividends, where they pay you a small monthly amount or a small quarterly amount based on how well they've done. They will then issue dividends to you. Now, just holding stocks then over time should result potentially, ideally, in growth of the money that you bought. So if you take $1,000 and then you buy $1,000 worth of stock and the company goes up or they send dividends, which they should be doing, then you will start getting some more money. Now, on average, since the founding, stock market goes up and stock market goes down. And there's been really bad years and there's been really amazing years. And when the stock market goes down, it usually goes down much more abruptly than when it goes up. It goes up slowly and goes down quickly, and that causes people to freak out. But broadly, the stock market has yielded around 8% return year over year since it was founded. There will always be people who point out that now where things are at is going to be worse than it ever was, but that has still remained the average. And there's been a few great years recently, even as people just doom and gloom. So overall, you could think of the stock market as a reflection of the economy. And if you believe that overall the economy is going to continue to grow, well, if you buy into the stock market, things will continue to grow. And I want to speak about the importance of this growth over time. So it's called compound interest, which basically means if you have this $1,000 and then it grows by 8%, and maybe that's a combination of you getting some dividends and also the companies that you've purchased growing. So that value now is 8% more. So now the theory is that 8%, so the $1,080 that you now have, that is now invested in the stock market, and that now will also start to grow as well. This is especially true of dividends that you receive, and then you buy again. Now, dividends are usually only about 2%, but still, if you turn around with those 2% and you buy more stocks, now you own a little bit more. So this compound growth, which means that the money that you have that has grown is now getting put back in and continuing to invest. And this concept of compound interest is very powerful. And it basically means the simple equation, just to put this in perspective, is if you take $1,000 and you don't touch it and you let it invest in the stock market for 30 years, the number at 8% return, which is still an assumption, it will add a zero to it. It will become 10 times more than it was. So $1,000 invested today becomes $10,000 in 30 years. 10,000 today becomes 100,000, and so on and so forth. And this is a very powerful concept. It shows you just how powerful it is to it's more important to start early, even if you're starting with less, than to contribute more later on. Because at year 25, if I'm trying to get to 30, I'm going to have to put a lot more money every month. If you put just $10, $100 in now every month, it's because if you are young, it will actually have so much more of an impact later on. And you might be thinking, 30 years, that's so long. It is, but we're going to live long lives here. Hopefully, that's the plan. And before you know it, you'll be grateful to your younger self for having that. 30 years passes quicker than you might think. And you might be surprised along the way to see how much things are growing. So just know there's a very powerful thing. Even this 8% return, which is a very nice return, it actually has this compound growth concept. And you can watch it, put it on a graph, and you start really seeing over time towards the end, a really upward swing. So in the beginning, you don't see much growth, and then it really gets much more dramatic very quickly. Now let's talk about the concept of diversification. Because if you look around, everybody's got the idea of this company, that company, this company's doing well, Tesla, Microsoft, Apple, AI. There's always a trend at any given time. The rule is, though, that typically it is impossible to predict which one company is going to do really well. And the history books are full of companies that were huge and amazing and are now completely bankrupt. They don't exist anymore. So there's a constant turnover. And studies have shown that generally speaking, if you throw stocks at a dartboard, you're going to do a better job predicting stocks than a professional stockbroker picking things. There's a lot of speculation, a lot of assumptions being made, and it is really hard to know which one company is going to do well at any given time. So my advice around all of this is to not pick specific companies. And this is just not just my advice. This is a very common advice. There's two broad theories in the world of investing. But definitely if you're going to be more passive, if you don't want to be involved in looking at stocks and analyzing companies, this approach that I'm about to describe is the way that is recommended. And it is the concept of diversification. And the idea is that you don't know which company is going to do well. So you just buy into a little bit of all the companies. And then you're no longer voting about a specific company. You're voting at the very least about a sector, like tech sector is going to do well. Or you're voting into a country, like the United States is the world leader in economic growth, and I'm going to invest in that. And so you're making a really long bet on the fact that society as a whole is going to continue to innovate and continue to create new businesses, and you just want to be bought in to all of that. And as all of humanity continues to work and innovate and grow, you just want to be riding that wave. You're investing your money in this belief that as a whole, the free market and the way that it grows has a lot of potential here. And so the concept of that was created. You might be thinking, I got to now go and buy there's thousands of companies listed on the stock market. I think just the US stock market has around 3,000 companies, and any other country has its share of companies. How am I going to go buy all of those? Well, in the 80s, they invented a concept called an exchange traded fund. And a fund basically means that you can buy, there's a company already out there going and buying a percentage of all those companies, and you just need to buy into that company, and you've got a share of all of it. So they've done the hard work for you of buying a little bit of everything, and you just buy into that. So they've made the concept really simple. ETF is what it's called. And they do the concept of rebalancing too, because what they're probably going to do is they're not going to buy an equal amount of a tiny company and a huge company. They buy a weighted amount, right? So if Google is worth $1 billion and another company is worth $1 million, they're going to buy 90% in Google and 10% in the other company, obviously average that over time. So as individual companies grow, they buy and sell small amounts of each company to keep the balance equal, so that you're not owning too much of one and not enough of the other relative to the entire worth of the company. So that's why diversification is broadly so important. Do not pick individual stocks and do not get caught up in the individual themes. Like crypto might be all the rage for a while. AI might be all the rage, but those typically rise and fall away. Okay, there's always trends, and they almost always are exaggerated. So if you are going to be sensationalist and just react to whatever your friends are putting all their money in Bitcoin, then that becomes the latest thing. And then when it crashes, you lose out. Instead, it is worth it to go on a much more horizontal approach where you've bought a little bit of everything. And yeah, it's not going to go up as high, not going to go up a crazy amount, but it's also not going to go down a crazy amount. Because even if one specific company goes bankrupt, you've got your money hedged in a lot of other companies. So this applies on the micro level, not buying that one company, but buying an entire sector, an entire industry or entire country, all of that. It also applies on the macro level, how you decide to divide it. So you could create a portfolio of bonds and stocks. So we spoke before about bonds. Typically, bonds fluctuate a lot less in their price because there is a market of buying and selling bonds. But overall, you know how much it's going to make. And typically, the growth, the rise and fall of the specific underlying thing, like the U.S. economy, isn't going to affect. They still owe you that money, regardless of how well they're doing. So bonds are more stable. So you could create a portfolio where, let's say, you own 20 to 40% bonds and then 60 to 80% stocks. And the overall advice, without getting too much into it, is that the younger you are, the more you have time for risk. So people who are in their 60s and 70s are advised to have more bonds and less stocks because stocks are more volatile. They'll go up and down more. And you want to stick to, at that point in your life, you don't have as much timeline to weigh things out. But if you're young and you still have time ahead of you, then you don't really care as much if the stock market drops by a whole bunch. You're not planning to withdraw the money anytime soon. You just keep putting the money in, and you have the timeline to wait for the market to recover. So you actually don't have to rush things, and you're probably still working. So you just get more money coming in, invest some of it away. So actually over time, as opposed to being retired and needing to live off of those funds, and if the value drops, you're at a stuck place. So again, the assumption here is that the stock market will go up and down. There will be bad years. We're not going to pretend that there isn't. But we're not investing in a specific company because that means that we're never going to lose our money completely, because if you own stock in a company that goes bankrupt, that stock now drops to zero. We're not doing that. And we're waiting. We're playing the long game. The longer you wait, the better you're doing. And part of this concept is that you can't actually time the market. You can't say, oh, now is a really good time to buy. Now is a really good time to sell, because you don't know. Maybe the market's going to continue going up. Maybe the crash is not even finished crashing. So the advice broadly is called dollar cost averaging. It just means every set amount of time, every week, every month, just put money in. Don't even look at where the stock market is holding. Some weeks you'll put the money in and the market will be down, which means you basically bought at a discount. You got stocks for cheap. Sometimes the stocks will be up and you bought things more expensively. There's actually a reverse psychology where people oftentimes will see their stocks dropping and sell, but that's the worst thing to do unless you have to, because if you wait, the stock might very well go back up. So if you sell, you're basically buying when it's high, when there's the trend, and you're buying when things are expensive and selling when things are cheap, which is the exact opposite of how everything else operates in life. So when the stock market's down, if you have the money, go buy some more. If you believe that the stock market will continue going up, which it inevitably has and continues to do. Now, an interesting point to think about is some companies offer this off the shelf. You can basically invest your money in, and they will create a diversified portfolio based on your own risk tolerance. You could tell them how old you are, what kind of stomach you have for ups and downs in the market. Are you willing to just not look at it for a while and let it do its thing? Or do you get more worried when it goes up and down a little bit? And based on that, they will create a mix of bonds and stocks and some cash for you. You just put it in, put $1,000 in, and they'll buy, the $700 of stocks and $300 of bonds. So this is often a concept that already exists, and that is often the simplest thing to do. if you want to do that way, definitely very much recommended. So with that said, let's talk a bit about what it actually looks like to actually go and buy stocks. So broadly, the concept of buying and selling stocks and bonds is handled by what's called a brokerage. And they're facilitating the buying and selling of stocks from individuals like you, or maybe from big companies that are also investing. Nonetheless, it has to pass through somewhere. And that's what these brokerages are. And typically, there's a bunch of ways in which the financial industry makes money off of an investor like you. First, there is the actual fund. Remember we spoke about before exchange traded funds that are buying and selling a whole bunch of stocks? Well, they have some costs still of running themselves. And so they might take a fee. So if you give them $100 and say, I want to buy the entire stock market, well, they'll buy $98 of the entire stock market and keep, let's say, $2 for themselves. But the truth is that it is actually really easy with computers nowadays to automate the purchasing and cost very little. So they might charge you as little as like 0.04%. And you want to be looking for the funds that are mostly automated. They don't have humans involved because humans oftentimes get it worse anyways. Just have a computer doing the algorithm, buying and selling the entire stock market, and just buy it. So you want to look for a fund that is itself not charging you a lot of money. And then the second intermediary is the bank or the broker, right? So you go and you say, I want to buy the stock right now. The brokerage will typically charge some percentage of it. And that is either upfront, they'll be like, yeah, we're charging you a percentage, or behind the scenes, they'll give you a price, but that price is actually different than the price they could actually sell it. Similar to an exchange rate. There's the buy price and the sell price, and the difference is the spread, and they're making some money off of you. So basically, every time you buy and sell, there is going to be some loss. That's why you don't want to be buying and selling regularly. You want to just buy and hold for a long time and then sell when you do. Anytime there's a transaction, there is a loss incurred there. And finally, there's this concept of financial advisors, financial managers. Those are people that you basically pay to handle your money. They take the biggest percentage, right? They'll be like, oh, take X% of the total amount that you make. And my argument is they're oftentimes unnecessary, especially for smaller amounts of money. And oftentimes they're not great. They're not so helpful. And the fact that they take a percentage of your total amount invested doesn't make much sense, because it's the same amount of work for them, whether they're managing $100,000 or $1 million. There really isn't much more that they need to do. You can buy and sell the same amounts. And the concept of them taking a percentage of your total amount invested, especially since it's oftentimes not related to whether it performs well or not, is really unfair to you. So of all the things, I'm kind of a financial manager unless you need them. So how do you choose a brokerage? The first thing to keep in mind is how easy it is to get started with one and how much they charge. Some brokerages really charge a ton of fees and some of them don't charge at all. A couple of years ago, Robinhood in the United States really created a revolution where they did transaction-free charges. Now, there were hard charges behind the scenes, but still it was a huge innovation, because until then, brokerages were charging, $5 each time you bought a stock. It didn't matter what it was. There was a huge cost, and that's led to a change in the United States, at least, where you can actually buy and sell stocks for free. It's a huge boon for average investors. And so that's one thing to keep in mind. The other thing is the ease of using the platform. Is the platform easy to navigate, right? This whole world can be made really simple or really complicated. And what is it like for you to add money in, to buy and sell the stocks, and then to withdraw your money when you, how transparent is it? Now, the United States leads the way with this. There are really a lot of amazing platforms. Other countries are somewhere in the middle. They're not great, but you can use usually one or two companies that are the go-to. And other companies really suck, unfortunately. And I'm not going to give you advice per company, per country, because you might be in all sorts of different places, but understand these are the things you're looking for. Banks in general oftentimes have brokerages attached to them. So you could deposit your money and they'll offer you to also, buy and sell stocks, but they are usually the worst. They have the worst rates. They're for people who are really passive and aren't savvy. It's better off to have a separate brokerage where you transfer your money from your bank to the brokerage and you actually do your investing separately. That is my general advice to you. There is still a concept of risk in the world of stock market. And so it's important to understand, just do an introspection to yourself. What is your risk tolerance, right? Generally, we said, sitting on cash is theoretically the least risky thing, but you're actually losing money. Because you want to push yourself out of that, at least to some degree, with at least some of your money. Bonds are safe, but don't yield much. Stocks yield more. Individual stocks can yield the most and the least. So those, in my opinion, are the most risky. And then overall, buying a stock market is somewhere on the higher end of risk. But if you have enough time, then that really reduces the risk. The curve of how much risky things are, if you average it over many years, becomes a lot lower. So I invite you to just introspect a little bit. Are you willing to ignore the news or just not check your bank account every day and just let the money sit and come back once a year and just assess where things are at? So you want to automate the money in, but not really think of what the money is doing while it's there. Just let it do its thing. You can think of it like a business that's running on its own. If you had a partner and you trust the partner overall, do you want to look over his shoulder constantly? Oftentimes there's diminishing returns. The more you obsess about it, just causes you anxiety, right? So just keep that your risk preference in mind, but also I invite you to loosen your grip a little bit on looking so tightly at how your money's doing on a day-to-day basis. I want to talk a little bit about tax deferral just because it is an important concept. In almost every country will be taking taxes from you. And that oftentimes changes by the amount of income that you're making. So if you have a slower amount of income, you pay less taxes. The higher your income grows, the more taxes you start to pay. And a lot of countries also have these systems in place to encourage you to invest, where they basically say, we'll let you invest money and not take taxes off of that money that you invest. And they typically offer it in two different ways. They either don't take money from you when you deposit the money, or they don't take money from you when you withdraw the money. You have a choice. Each has its own benefits. So if you're going to deposit money, let's say you right now have to pay 15% taxes a year. Well, if you're going to defer the taxes at the beginning, that means you get to put an extra 50% in. These $100 you're going to put in right now, the government would normally take $15 from to themselves, but they say, we'll let you keep that full $15. You can put all of it into the stock market or into your investments. So great. Now you've got $15 more in there that you didn't have before. And those $15 can now go for 30 years, remember, and get all that extra growth. And then you'll deal with the taxes on the other side. When it comes to withdrawal, you pay money on those withdrawals. So that's one way to think about it. The other way is you put your $100 in. After 30 years, it becomes $1,000. And when you come to withdraw it, then the government says, no. So this second option, you put your $100 in, you pay taxes on it. So you actually had to pay you took $115, 15 went to the government. I'm simplifying the net math here. And now 100 goes in. It grows to 1,000. Well, that $1,000, the government says we're not touching because you already paid taxes on it and it grew and we're not going to touch that. So those are two things that exist, and it's very valuable to navigate taxes within your investment strategy because the government is often taking such a huge percentage of your money in taxes that to first make sure that you're capitalizing on any opportunities that exist there is really valuable. There's oftentimes an upward cap on how much you can do. Different countries let you do a maximum of a certain amount of money that you can invest this way with tax deferral, but that's always the place to start. If you're going to start investing your money, always invest it in a place that actually lets you avoid some taxes, that if at all possible, and only then do it in what's called taxable accounts, where the government takes money when it goes in, takes money when it goes out. That is a lot less profitable to you. So always keep an eye out, inform yourself on your country's tax benefits, because it can far outweigh even the growth in the stock market. If you're paying 15% taxes and you immediately avoided 15% taxes just by putting the money in the investment, even if it grows 8% a year, you already saved 50% off of paying that in taxes right now. Now, some people in the world of capitalism are worried about the ethics of what they're investing. So I'll speak briefly to that. There's more of an increased awareness over the last few years around not all companies being equal. Some are doing really good in the world. Some are not. Some are thriving off of prisons or off of being really bad for the environment or really, weapons, right? Manufacturing weapons. So depending on your own ethical and feelings around it, it's actually possible nowadays to buy into the economy without buying as much as possible those specific stocks. Different companies will assess the behavior of certain companies and buy stocks that avoid those worse companies. It varies. You can do ones that are more focused on economy. You can focus on things that are focused on the leadership or how the companies themselves, are they operating sweatshops for the employees? Or are they treating the employees nicely? So it really varies. It's not perfect. Some of the terminology you encounter are things like ESG. ESG stands for environmental, social, and governance, those different factors that they're assessing companies for. So you could buy that. There's oftentimes a decrease in yield because some of the worst companies are the ones that are making the most money. So you're removing yourself from being involved in some of those. And there is the point to be made that all of this is happening in the secondary market. So the companies already made their money when they issued the funds. Right? The moment they go public, basically, and put their money in the stock market, that's when they get cash. And when you buy after that point from somebody else who, Joe Schmo was selling their Amazon shares, it doesn't really affect Amazon. That money that you paid right now doesn't go to Amazon. It goes to Joe Schmo. There is the fact that everyone's buying does increase the value of the stock, and Amazon might still own their own stock and they could sell it. So there is some growth happening. There's far more impact when you go to the store and you buy an ethical product or an unethical product. That's where the money is typically going right back to the company. So what you buy directly on the day-to-day has more of an impact than what you buy in the stock market. But keep that in mind. It is a factor. in all of this. And there are opportunities and ways around it to govern it. A key important thing in all of this, if you do want to move forward with investing, is to really automate things. You probably are not that interested in managing your money on a day-to-day. And so you can do some things that put them in place and really set it and forget it. And so what it does is, first of all, it allows you to prioritize yourself. So if you have money coming in every month and you immediately remove some of that money and put it in investments, you very quickly get used to it not even being there. And you are basically paying yourself first before you go out and spend it or anything like that. Especially if you get a raise, consider taking a percentage of that raise and put it away immediately. Removing it from your bank account decreases your chance of spending it. It removes any emotions that you might have about needing to remember to do it. And investing regularly does that benefit of dollar cost averaging, where you'll sometimes be automatically, without even thinking about it, putting it in when the stock market is low and sometimes when it's high. So actually, sometimes when I advise people who have a bunch of cash that they want to invest all at once, I advise them to still buy it over time, because you'll get a more average price instead of buying accidentally when the stock market's doing really well, then crashes the next day, you have gone down in value. So typically most brokerages have something in place where you can automatically set a transfer. It's in their interest. They want more of your money. So you set it up every month, the money goes from your bank account into there. And ideally you set it up that it also automatically buys a certain amount. You could tell it, I want to buy $100 a month of SPY, which is the top 500 companies in the United States. Or I wanted to buy $100 a month of VTI, which is the entire stock market in the United States. So you go ahead and you buy that amount. It starts buying it automatically. You don't have to worry about anything else beyond that point. So it's going to vary a little bit between each brokerage and each app or platform that you're using, but the idea is the same. Set an automatic transfer of funds in, and ideally set an automatically purchase amount in. And the cool thing about a lot of these brokerages nowadays is they don't care so much about the actual stock price. The stock might be selling for $273. But if you put in only $100, there's something called fractional buys, where they'll buy part of an entire share, still you invest that way. So fractional buying is becoming very common, and you could just literally put a dollar sum of any amount in and start investing. So when you're choosing a broker, I invite you again to not choose your bank. Find a brokerage that will be easy to use, that doesn't take a lot of fees, and lets you do some of these automated investing things so you can really set it and forget it. If you are considering a financial manager, these are the things to keep in mind. I find that the average person doesn't really need it. Between the robo-advisors that automatically just create an entire portfolio view with a mix for use of stocks and bonds, or just buying some ETF funds yourself, that's, I believe, the way to go for most people. But sometimes if you're really, really stuck and there's no way that you're going to invest your funds without a financial advisor, technically a financial advisor would be worth it. Although oftentimes if you have very, very small money, we might not want to deal with you at all. The other option is if you're very wealthy, that's where your situation might be more complicated and you need more tax advice. And that's where you might consider a financial manager as well. Broadly, think of your financial manager as a therapist. Okay, they're your therapist for money. Hopefully they have their best interest in mind. You really want to clarify with them directly, as much as this sounds absurd. Clarify if they have fiduciary duty to you, if they are obligated to give you the best advice, even if it means a loss of money for them, because it used to be for a long time, they could sell you a stock that made them money, even if it wasn't the best stock for you to buy. That's changing, thankfully, but that's still an option, reality. Consider finding financial advisors or managers who bill at an hourly rate, and then you're just paying them for their advice as opposed to a percentage of managing your funds. But broadly, again, think of it as a therapist. Think of it as somebody who can really support you through the emotional journey of all of this, helps you figure out your plan for your finances, helps you not sell when the market goes down. They just tell you to hold steady, okay? But broadly, that is the main purpose of the function. This isn't rocket science for the most part. The more complicated things start to get, the less helpful it is. So the broad strokes are the most important. Either way, the more educated you are, the more you'll be able to have mature conversations with your financial manager, and they'll respect you more. You'll be able to ask good questions, and you'll be able to keep your money safe and everybody aligned to your goals financially. I want to talk a bit about spotting scams, because if you're new to investing, as you go out there, you're going to encounter a lot of different people who try to get you to part with your money. Okay? So how do we recognize a scam and make sure that you're safe? The underlying thing that I want you to always be looking for is, where is the value here? What is your money buying into? What is the actual venture? Does this thing have inherent worth? Think of a company, Microsoft. They're producing software that helps people be productive every single year. Amazon, delivering also products to people all over the world. Now, you could agree or disagree with it, but if you look around, there's people who are using Microsoft every day. They're using Amazon every day. They're driving Teslas. So at the very least, I understand what is being sold here. If you don't understand what is being sold, if it's some complicated thing, if it's just an idea that's going to be huge in a few years, those are all red flags. You need to see it actively solving a problem right now that people you know, are actually dealing. This is a fundamental concept behind investing. And one of the best examples of this not being true is the whole world of crypto. Crypto was a cool idea to begin with, but on the day-to-day, you look around you, nobody's buying and selling crypto, okay? It's not something that's helping anybody at all. And the value is going up purely because everyone else is buying. But you don't want to be holding something that is only worth something because everybody else thinks that it's worth something. It is some sort of means to an end that could dissolve in a second if everybody changes their mind. And that's different than money, cash, which is backed by an entire specific government. The government is doing a ton of things on a day-to-day that is contributing to the value of that cash to some degree. And as you look around you every day, people are exchanging things with that cash. So until Bitcoin is so prevalent that you can actually go to the supermarket and buy something with Bitcoin of cash, and don't give me some random example of some website you've heard about, but it really needs to be something that you're encountering every day. And then you could say, okay, yeah, it's exchanged itself for currency. And the other thing, again, very simple, is the concept of diversification. You meet some guy and he's a genius and he's the best and he's put all of his money into something or he's doing amazing things and you really trust fully. Don't put all of your money with this one person because he could be ahead of his first disaster in his entire career and you will be along for that ride. Okay. It doesn't even have to do with his honesty, which might be a factor here. It can also just have to do with luck. Okay. You put all your eggs in one basket, no matter how good that basket seems, the handle can fall off and you lose all your money. Always diversify. The higher risk the thing that you're putting your money in, the less percentages should be in there. Okay. So if you've got this really genius, amazing thing that could yield you a ton of money, put 5% of your total investable money into it, 3%, and it's much more of a gamble. And take the rest of your money and put it into something that is much more trustworthy, something that is tried and true, that thousands of people are doing, that's yielding a smaller but more manageable yield. Okay. The more extreme the yield, the higher the promise, the more you need to doubt whether it's true. The concept of too good to be true is real. The actual stock market has grown by X amount for so many years, and that is a reality of it. When somebody comes to you and says, I'm going to give you 16% return on something, you got to be very suspicious about what it is that they're doing and how are they able to give you so much money. So that's it. My invitation for you next steps is continue to educate yourself. Go ahead and open a brokerage. It can be a little bit bureaucratic, consuming, depending on the country you're in. Uploading some documents, taking a photo of your ID. Give yourself 30 minutes of just throwing yourself at this somewhat annoying task. 30 minutes, see how far you go with actually opening it. And then sometimes once you've opened it, it can take a few days for them to verify you, blah, blah, blah. So take some time. And when you can, as soon as possible, transfer a very small amount in it. It could be $50, $100, doesn't have to be a lot, but that act of you moving your money from your bank account into an investment account is huge. And once the money's in there, I invite you to go and buy 2 ETFs, 2 exchange-traded funds. $50 each, something like that. Doesn't have to be a lot. But again, I'm not giving you financial advice. This is just an example. Stocks you could buy: VTI, which is a great company called Vanguard, buying the entire US stock market, or SPY, which is the top 500 companies in the United States. You'll automatically be buying into Google and Amazon and all that stuff. Okay? Go ahead and buy the stock. Go through the process of what it's like to pick it, to tell that you want a fractional share, to tell that you want it to just buy it at the current price. All of those little technical things that they can sometimes be annoying about. Go through it. The worst that'll happen is you mess up somewhere along the way. You're not going to lose your money. Okay. You might lose a few dollars here and there because you on some fee or something like that. That's all there is to it. Go ahead and buy it and then watch for a few days. Watch, maybe it goes down a little, maybe it goes up a little bit. You have now officially invested. And once you've done that once, all it takes is just to automate it and to do more of the same. I'm going to include some links as well that you might find helpful, depending on maybe some of the countries you're in. But overall, that is the basics of all of this. One last thing that I invite you to do is to track your net worth. Have some sort of spreadsheet where you keep track every so often of how much you are worth in total. And that basically means all the things that you own, especially cash, minus all of the debt that you have. So if you have saved up $10,000 and you have $2,000 in credit card debt and $1,000 in a car loan, your net worth is $7,000. You take your whole value minus your cost. And it's very cool to invest and watch over time as your net worth grows. Okay, so I'm going to include a link to that to some tools that can help you with that. I hope you find this helpful. If you have any additional questions, let me know. And I wish you much luck in your investing journey.